Welcome to tonight's lesson. Okay, and thank you for those who understood the events of what happened yesterday. For the purpose of quality and the purpose of those who will be watching, I'm going to redo the trading terms module again so that everybody can get it without interruptions, inshallah. So we're going to go through today, we're going to go through some trading terms. Then we're going to talk about a trading journal, why it's important. And then we're going to go through candlestick anatomy, part one. And that will lead into going into trading personality, aka market structure, where we'll go in to talk about support and resistance and trend movements. So I hope that is okay with you. Let's go through some trading terms and add some more sauce on this particular boot camp. Yesterday, we spoke about different trading terms that I want you to be using and why they are so important. And we started off with the term of stop loss and what that meant. And pardon me, because I normally go off the dome a lot, which means I go by inspiration. I'm a very impromptu type of speaker. My definition might not be the exact same as it was in the other version, so pardon me. But stop loss is a protection you set to minimize losses. Okay, so it's a protection that you set to minimize losses. In other words, when you're looking to trade one way and the market goes against you, you set a protection level that if it goes against you X amount of pips, then your trade will be taken out automatically in a loss. So now when you're thinking about being an investor or a trader, you are thinking about, yes, I'm looking towards making money, but in case it doesn't go the way I expect, or in case there's some form of unexpected turbulence that takes place, if it goes against me negatively, my whole account will not be affected, only a portion of my account will be. Type in a Y or a yes if you're with me. So the example I use, that if you're looking to buy, okay, and you set your buy down at the bottom over here and you're getting very, very happy and you're thinking it will go all that way forever and ever, and then something happens and maybe the market wants to come back down, because you set your entry point, okay, at that level, if it goes in your direction, it will be positive and it will reflect as blue. If it goes against you, it will show as red, and we hate red over here. So if it starts going against you, instead of waiting for your account to go down to zero, you can decide that you want to risk a small proportion of your account, whether it be $5, $10, $20, but you cannot just say that in terms of dollars, you must use pips. So we went and used the example of, if I had the $100 account, and I wanted to risk $10 using a 0.01, it means that you're setting your stop loss at 100 pips. So if the market goes against you 100 pips, once the market tries to exceed that 100 pip mark, your trade is taken out automatically in a loss. Not all losses are bad, but all losses can be prevented, okay? Or the magnitude of losses can be prevented. So that is why we have a stop loss. And in your trade, the next thing that is important after your entry is your stop loss. I would rather have this part of your trading plan, which we will cover later, than you having a trade that is completely open. So remember to always have a stop loss. The next one that we covered yesterday was TP. All right, it's either known as your target price or it's known as your take profit, okay? And this is, okay, the level you set in the market where your trade is taken out automatically. Look, the definition is longer here. Automatically in profit. So how do we condense this down? All right, it's known as a TP. Stop loss is known as an SL. And what we're saying is that, okay, you have a projection out maybe 100 pips, 200 pips, 350 pips away, but you want to set a marker somewhere in the market so that when price hits that point, your trade is now taken out automatically, but in blue. Your stop loss is taking it out automatically, but in a loss. The take profit is taking out automatically in profit. So if you are someone that has a busy schedule, you might work an 8 to 6 or a 9 to 5 or a 6 to 6 or maybe a 12 to 12, and you have the excuse of, well, I work all the time, so I can't watch my charts. Well, the good thing is you don't need to be in the market all the time anyway. So what you can do is when you are mastering a particular strategy, you can set that target so far that no matter what happens, your phone damages, your phone turns off, you're in traffic, you can't charge your phone, it's light off, whatever the excuse is, even if you're offline, your target will be taken out and your trade will be taken out in profit. That's the beauty of having a target price or a take profit. Now, out of these two, the stop loss and the take profit, the most important out of the two is the stop loss. Why do I say this? It's because I would rather know how much I am losing compared to how much I am making. Because in this game, it's not just about attaining money, it's about the preservation of money. It is making sure that you have great wins but minimize your losses. So I'd rather you in every single trade to measure how much you are willing to lose. And with the stop loss, you need to come to a place that you are willing to lose. If you've come into this business thinking that I never want to lose, guess what? You are going to lose. And I remember making this reference that Job, as blameless and as righteous as he ever was, uttered a phrase that made him realize that he wasn't as righteous as what the writer claimed to be. And that was, he said, what I have feared the most has finally come upon me. It means that through all of his righteousness, through all of his sacrificing, through all of his intercession, his fear was that I'm going to lose it all one day. And it actually came to pass. So you cannot put into your head when you're trading that I'm scared of losing, I don't want to lose, I don't want to lose, because guess what? Whatever you focus on is what you become. That is why the New Testament tells you that you need to be grace conscious, not sin conscious. Because if you focus on sin or not sinning, you're going to end up sinning even more. But when you focus on grace, you realize how gracious our God is. So focus on minimizing your losses so that you can look towards where your take profit is going to be. I hope that explains a lot. Another thing is, another term that you might want to get familiar with is entry. I mean, it's pretty simple, but I'm going to put it down because everyone is going to ask you sooner or later when you complain about your trade and you say your trade isn't going the way it worked. You're going to be asked, what was your entry? The entry is the place in where you entered into the market. I don't think I need to write that down, but because of note-taking sake, let's put that down. Entry, the place in which you entered your trade. That place is a reference point, okay? So you have 3 dimensions with these trading terms so far. You have your entry, that is you. If it goes in a positive direction, it means it's heading towards your target price or your take profit. If it's going against you, it means it's heading towards your stop loss, all right? Entry is you, take profit is your destination, and stop loss is your cushion to prevent any damage to your account. Having these 3 things ingrained into the mind will help you very, very much. Now, speaking of entry, there are different types of entries that you have in the market that you need to pay attention to. And these things are called order types. They are types of orders that you can execute into the market. And we have 5 of them. And one of them is what you're going to be used to, but the other 4 are what we call conditional based trades or what we call pending orders, which means they need to meet certain conditions in order for the entry to be valid. So let's go through the first one, which you'll be accustomed to, and that is called instant or market execution. Now they're going to be named different because if you're using a demo account, it's going to be named one. If you're using a live account, it will be named the other, but they both mean the same thing. What does instant execution mean? It means that from the second you press on buy or sell, your entry becomes valid. So you're looking at an opportunity in the market and you're saying that you want to make maybe 300 pips, you have your stop loss in place, you have your take profit in place, and you press on buy or sell. What happens is that your trade is entered automatically. Now, I want to add this, I know I didn't add this yesterday, that no matter what happens in your instant or market execution, your trade should start off in red, okay? Take note. People will blame the broker so much, but I'm going to explain why your trade will start off in red, okay? So, side note, any trade you enter may start in red, which means it will start as though you are losing. There is a reason for that. I hope everyone took note on this, okay? Because as beginners, we're trying to make sure we're dotting our I's and crossing our T's, but we want to make sure that we're getting the right information. Why does our trade start in negative? The reason being is because you don't have the money or the capacity to be able to trade on your own accord. You need a middleman that can validate your trades for you. And that middleman is called a broker. And that broker, what they do is they will use your trade, they will add their leveraging power to make sure your trade is entered into the liquidity provider, else known as the marketplace. And so the best thing about understanding your trade being in red is that if you are paying for a fee, that is being deducted out of any trade that you take. It's like going to the shopping mall and you're paying something and then there is tax. Maybe a biscuit is 1 cedi, but at the end of everything, it'll be 1 cedi 15 pesos because that 15 pesos was the tax that you paid. And so you need to consider that every trade that you are paying a dividend to that broker to make sure that your trade is entered into that marketplace. And that is called a spread. That spread is the broker's commission to allow your trade to be entered into the market. Spread is not a bad thing, ladies and gentlemen. In fact, I want to divert a little bit and state that if you have a broker that has zero spread whatsoever, you need to be very, very careful. Now, because of education purposes, I can't mention a preferred broker because I can't sell a broker because we're an educational platform. But any broker that promotes zero spread, you need to look at one eye at. Why do I say this? You should be able to pay a commission. That commission validates your trade into the marketplace. If you are paying $0.00 for a trade to be in the market, chances are your trade isn't in the market in the first place. AKA, if your trade isn't in the market in the first place, it opens the door for what we call manipulation. And that manipulation can be such where that particular broker can deliberately trade against you for your account to be blown. Type in a Y or a yes if you're with me. I feel like it was my duty to add this information in. And I'm kind of glad that yesterday happened the way it did because it allowed me to add more secret sauce on top of today's lesson. So any trade you enter, understand that it will start off as red. The justification is that you are paying a commission to your broker to allow your trade to be entered into the marketplace. Okay? That commission that you pay is paid once. The condition is that when you hold your trade, side note 2, when you hold your trade, over, or let's say before, I'm trying to word it nice. When you hold your trade and it crosses the next day, in brackets, I'm going to put New Zealand session. You are going to be charged interest. And that interest is called swap. Okay? Now, the beautiful thing about swap is that every broker has terms and conditions with their swaps. There is swap long and there is swap short. And what happens is that, let's say, for example, you entered a trade 2 hours before New Zealand session opened. As soon as your trade crosses over into the New Zealand session, you are going to be charged an additional interest, or you will be paid an additional interest. So you need to be able to look at your currency pair, which we will go into later, and understand that if I am holding a buy with a particular currency pair, I will either pay interest or I will be paid interest by the broker. So don't look at swap as a bad thing. Now, this is where I do another discretion or another disclaimer. Side note part 3. If you are a Muslim, it is haram to be doing anything to do with interest, okay? In order to be able to preach to a people, you need to understand where they are coming from. So my responsibility is to make sure that you're not sinning, because woe betides anyone that follows Allah that leads them into a ditch. So I can't allow you to pay interest unknowingly. This is why I'm telling you. So there is an account called Islamic account. Now, Christians, don't go there, all right? Stay in your normal lane. For Muslims, there are Islamic accounts, which means that you do not pay interest, neither will you be paid interest. So if you're a Muslim and you're entering into our academy and you're signing up to our preferred or recommended broker, you need to specify at the very beginning that you are a Muslim, and you will be granted an Islamic account where you will not be charged interest. However, you still pay broker commission, which is the spread. I hope you understand that. Now, Christians, don't try and take a shortcut in life, because Jesus says, whatever is Caesar's, give to Caesar. We pay tax, we pay interest, okay? And the Bible also says that we shall be lenders and not borrowers. And borrowing connotes that when you're paying back with interest, amen? So if you're a Christian and I find that you've gotten an Islamic account, I will find you and I'll hunt you down in your sleep, all right? So those are the two things that you need to pay attention to. Islamic account means that you will not be paying swap or interest crossing over to the following day. Regular accounts mean that you will pay or be paid that amount. That is all part of order types and side notes and everything like that. So I hope you understand the concept of instant and market execution. Let's go on. Let's talk about the conditional trades. Oh, I even have the notes here. The conditional trades are called pending orders, which means that your trade needs to meet certain conditions in order for your entry to be valid or to be entered into the market. So there are 4 types. There are 2 for buying, and then there are 2 for selling. And we're going to go through each of them and add a nice definition so you know exactly what you're looking for. As beginners, you're going to be a bit skeptical of these order types because it's kind of a calculation-based thing. But as you grow, particularly in uni, I mean, a lot of people like these sort of conditions. David, you like pending orders, right? Which pending order do you like? See, David is a limit trader, right? But most people like stops. And you'll find that those who like limits hate stops and vice versa. So let's go through them so you know the difference between all. Let's start off with the buy stop. On the other side, I'm going to put sell stop. And then bottom left, I'm going to put buy limit. Sorry. And then on the bottom right, sell limit. These are the 4 conditional based trades that you will use when you grow in this academy. Let's look at buy stop, for example. Buy stop simply means that, let me use a pen. Your entry, or you're currently at this point in the market, and you've seen that the market came from a high point, and you're looking to now go up, but you're not sure if it will go up from there. So you're placing a condition in the market to say that if the market or price reaches this level in the market, what will happen is that my trade will be picked up automatically in a buy. Your current position is here, but you're looking to enter over here. So how do we define this? It is where entry price is above current price. That is, okay, that might be a bit too small, sorry. So that is the buy stop. You're looking to buy, but you don't want to buy right now because you want the market to meet certain conditions in your trade. So you're going to say, I want to set a parameter maybe 30, 40 pips above. And if my trade is valid, or if my analysis is right, what will happen is that my trade will be picked up automatically in a buy. Okay? And we said that David does not like this. I'm a buy stop type of trader. I don't really like limits. I can trade limits, but I prefer stops. So you can see that depending on your trading personality, it will determine the type of conditional trades that you're going to use. So what's the difference between a buy stop and a buy limit? A buy limit is where the market is coming down and you are anticipating that a reversal is going to take place at that particular point. So you are now here, but you want to enter over here so that the market is able to be picked up and go in that direction. You are above, your entry is beneath, but you're still looking to buy. So how we do this in a definition form is where current price is, or let me put it in the same order. Entry price is below current price. I hope everyone is able to understand that. So they're both looking to buy, but these are different conditions. And that is, one is looking to carry on with the momentum in the market. And if the momentum is going towards a buy, they're going to be buying and it will trigger them automatically. Okay. Now, buy limit is that you want to buy, but you're anticipating a reversal at a certain point in the market. So you want the market to come down, then it will pick up your order automatically in a buy, and it will carry off in that buying momentum. That is the buying proportion of pending orders, conditional trades. Now, sell stop and sell limit are simply the opposite of what buy stop and buy limits are. So let me do a quick diagram. I hope everyone is drawing in their notebook. And that is, you are up here, okay? Prices come from a low place to a high place. You are now here, and you are anticipating that the market is going to come down, but you're not too sure yet. So you set a marker just below. So hopefully if the market then turns around, your trade will be picked up automatically going for a sell. So the definition in this case is entry price is below current price. See how they're just opposite? Buy stop is that entry price is above current price. Sell stop is where entry price is below current price. When I first started, this stuff used to get me so confused. Thank God for growth, right? Okay. And so sell limit is just going to be the opposite of buy limit. And what happens is that you're anticipating a reversal somewhere in the market space. You are here and you want your order to be picked up here. So what you're waiting for is the market to follow your condition, it be picked up automatically in a sell, and then your trade starts going down like that. And the limits are what David prefers. The stop are what I prefer, okay? So depending on your trading personality, you might say, I only like buys. I only like sells. I only like sell stops. I only like sell limits, okay? So as time goes on, depending on the strategy that you're going to pick, it's going to determine the type of order types that you are going to use. And these are called pending orders. Hope we are good with that. So we're looking at all these terms. Now we want to go through pretty much our last one for now at this level. Everything else from here on in, you will experience it. You can ask questions. It will be answered in the group. But we're looking at currency pairs. Actually, there are a few more I'll add as well. So we're looking at currency pairs, what determines spread, and if we keep on going on, we'll go on from there. So currency pairs, we touched on this in the first and that team is called right hand side that is fighting for value to go down. They are the bearish team. Folks, give me 30 seconds